Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about this very important jobs week. Also, we'll get into the Fed drama a little bit, but we're so excited to dive in. First, I want to say thank you to our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the
It is
podcast.
wonderful to be here. I'm in lovely Lincoln City celebrating my 50th birthday. I'll be climb I'll be
There
climbing
you
rocks
go.
soon, zip lining. So if something ever happens to me, it has been a wonderful journey defending America against the American bears for the last 14 years.
I love it. Okay, so huge week this week, a jobs week like no others coming up before that September Fed meeting. So tell us what to expect. Do we have job reports coming out almost every day this
Yes,
week?
and of course, this is Friday morning. The PCE inflation data came out. By the way, bond yields ticked up just a little bit. Mortgage rates were flat for the day. The spreads are doing their thing. It is so wonderful to see all the other economists and everyone else starting to. We were doing spreads before it was cool, before it was a thing, and it's beautiful to see it work as it has through every cycle post World War II.
It has. So we're recording this on Friday, but it's going live
Tuesday,
on
yeah.
Tuesday. So we'll talk about this week being
And
the
this is,
jobs
and
week.
again, the labor over inflation argument now with jobs week is going to be critical because this is the last jobs week before the Federal Reserve meets in September. So a lot of people were thinking, why is the 10-year yield, at 420, 424, this Monday pricing? Again, 65 to 75% of where the 10-year yield and 30-year mortgage rate can range is still somewhat Fed policy. Uh, um, and as the 2-year yield starts to come down, as the 3-month yield starts to come down, you get more short-term pricing. This doesn't mean that the 10-year yield can't spike up and everything. For those of you that were in the industry in 2013, we had zero interest rate policy, and the Fed talked about the taper, and bond yields shot up from 160 to 3%. Mortgage rates went up 1% back then to 4.5%, and people were freaking out. Times have changed. Um, but now we're going to get to see a good test. We have the inflation data already in place. Of course, the growth rate of inflation is not heading back down to 2%. And now we get some more goods inflation probably kicking in here. Um, how does the bond market react if the jobs data gets better?
This is the question, right? This is what I feel like you're the one who's been looking at this. And, for our industry, of course, we never want the people to lose their jobs or go into a recession, but lower mortgage rates is key to our industry. So, everyone's watching like what
And,
happens.
and this is the thing with the spreads being better now, um, it's not a big as impact as it was, let's say, in 2023, where now we are seeing lower mortgage rates with higher yields now. But to me, the last jobs report, last BLS Friday report, we have job openings, ADP, jobless claims. What it showed was that the Federal Reserve really does need like the labor market breaking, right? I mean, we're sitting here with a 3-month job average of 35,000 per month. We're sitting here with manufacturing jobs being lost, residential construction jobs being lost, especially trade construction jobs being lost. And it's okay because we're not a neutral policy yet. We're heading toward neutral. It could get there maybe at the end of 2026 or 2027. But in any case, we're not at neutral policy based on what the Federal Reserve is telling us, right? It doesn't matter what I think or stock traders think or YouTubers think. The Federal Reserve believes they are modestly restrictive. This is why Waller and that group of the Federal Reserve, remember, the Federal Reserve has a civil war now. Remember, we wrote about that months ago. We said, get ready for the civil war. And we have this civil war. But the question is, it doesn't take much to make the labor data look fine now based on the Federal Reserve. They're telling everyone, well, if jobs are just going at 50 to 75,000 a month forever, it's okay because population growth is they have a very low bar for the jobs data if it comes out at like 155,000 or something like that, and you have positive revisions. The Federal Reserve, some members could say, hey, listen, the labor market isn't breaking. We need the labor market to break for us to get even more dovish. So the conflict is here. We've been setting up this conflict since the end of 2022. labor over inflation, and now we have different factions of the institution ready to fight each other with. So I think this, out of all the jobs weeks that we've had since late 2022, this will be the most fascinating to see what the bond market does, because Jerome Powell's is coming to an end, right? His tenure is coming to an end. But who President Trump picks and how many votes does he get? There's more stories about Fed Governor Lisa Cook today. It's just one of these things where I really would love to see how the bond market reacts if the labor data just beats estimates, and where this can go, because it really took one of the weakest 3-month average of jobs creation in the 21st century for the bond market to basically slap Jerome Powell in the hand with a big old ruler too, just wham, you know, and say, "Yep, it's labor or inflation, and you've lost your labor costs." So that's a good thing, because there's a lot of Fed governors, Beth Hammack and everybody says, "Oh, listen, we shouldn't be cutting rates. We should." So there's a good conflict between the Federal Reserve, and now there'll be a good conflict between the bond market and the labor report. This is so fascinating for me because I've been waiting for this for a long time.
It's interesting because even people who never don't even know there's a jobs report, I think right now are paying a lot of attention. Of course, people in our industry pay attention, but it's when you have relatives who know nothing about this, they're not in the industry, and they're asking you, and you're like, wow, it is definitely, this whole Fed battle has definitely penetrated all the way to Main Street. Like, people know about it. So here's my question for you, Logan. With that 35,000 a month over 3 months average for job growth, what is the expectation for this jobs report that we have to beat?
It's funny. Nobody trusts the BLS jobs reports, and now President Trump has his own guy in there. This is just basically a kind of a toss up to.
Okay, wait. Do you trust the
I,
BLS
I
jobs
mean, I
report?
mean, the BLS jobs report is a trending jobs data that has been correct if you look at it in the correct way. There's always revisions out there. I would say that what happened last year is that the jobs data was stronger than my forecast, but I said, let me wait for the revisions to see if I get it right. To me, it looked right last year after the revisions. Whatever everybody else thought is something else. People are saying, oh my God, they do these revisions. They've done revisions every year for decades, and the revisions have actually gotten better. But now we're looking at it and thinking, okay, so how are the jobs data is going to be reported? Because the president of the United States fired the head of the BLS because it was a bad report and thought that it was a conspiracy against him. So now he's got one of his own people in there. So we'll see how the jobs work. I don't know how he can keep his job if the report's bad. You set a precedent when you start firing people for reporting the data. And in this case, it doesn't take much to beat the last 3 months. I mean, even if jobs were at 55,000, where other people would be going, that's very low jobs growth. The Federal Reserve has already told us that because population growth is slowing down, we should expect slow jobs out there. It's jobless claims that is the last and final kind of defense for the Federal Reserve's labor. And that the initial jobless claims are still low. 4-week moving average is still low. Continuing claims being at a 3-year high doesn't matter to the Fed. As Jerome Powell said, hey, if you're looking
Okay.
for a job, tough. Hey, listen, it's hard out there.
That was a
We
couple
don't
months ago. He was
we
like,
don't
yeah,
care.
it's tough out
We
there.
don't care. My God, wage growth is still too high. We have to make sure to attack the labor supply. Why? If you attack the labor supply, you can get wage growth down. And why do we always talk about this? Because this is the real nerdy aspect of Fed policy. The Federal Reserve does not believe in the productivity holy grail of AI or anything. I mean, AI in a sense is inflationary. You could see it in electricity pricing, but if you don't have the productivity gains, then you need wage growth at 3%. You have to suppress wage growth if you're the Federal Reserve. There, under no circumstances can people make more wages because inflation will take off. So 3% wage growth, 1% productivity, 2% inflation. I don't make the rules, they do. So this is why we harp on this. Attack the labor supply. Attack, attack,
Yeah.
attack. Wage growth being here. Now they'll say, well, wage growth right now is currently not inflationary. They were saying that, and while they were saying wage growth is too strong, we have to attack the labor supply. So it becomes this really good conflict about, Japan is seeing wage growth finally because their population is dying, so they need more older workers to stay working. They just don't have enough people. So their wage growth is picking up. We're not in that category yet. We still have a lot of good replacement workers, but the question is now, um, what reports will make the Federal Reserve say, hey, listen, you might get the one rate cut, but nothing else is going to happen? And are we going to be just stuck here for the 10-year yield just being at this elevated levels? And really the mortgage spreads has to be the story going out for 2025 and 2026. Or as we talked about in the last podcast, the White House is going to start saying, hey, listen, look at ARM loans. ARM loans are sub 6%. We're going to cut rates. So there's this huge dynamics, but all I know is that the president of the United States fired the person who was doing the BLS because he thought there was a conspiracy against him. And he put in a guy that I am very questionable on running economics. And I don't know if he will be strong enough to tell President Trump, listen, the jobs report is here. So we need to test this, right? We have a theory, but we'll test this out.
Right. So this is the thing that confuses me though. If Trump wants a better jobs report, that goes against lowering rates. So this is my question is like, where's the disconnect here? Because, it's a whole separate problem. Like if we can't trust the jobs numbers, but whether they're fudged because he has his own guy in there or whether they come in better, that doesn't lead to lower mortgage rates.
He can do it with short-term rates. This is why we talked about
Okay.
this.
So explain
We talked
explain
about
that.
this in the last podcast, that
Right.
what if the White House is thinking, hey, listen, the long end is not going to come with us, but if I get my own person, remember, if his own person really isn't Christopher Waller, it'd be like getting Kevin Hassett or Kevin Warsh, and Trump gets what he wants. We're going to cut short-term rates down to the Fed funds policy to 1%, and we don't care what the long end does because we're going to get ARM loans out there for Americans. Because remember, it's the whole Trinity argument for the White House that we talked about since last year is that they want lower dollar, check, lower energy prices, check. They need lower mortgage rates. If they get that, you don't necessarily need it with the 30-year if the short-term rates go down. So it's fascinating. I mean, this is really like government coming in and running the economy based on their own government models. This is not common, but it is interesting to see this dynamic that I think we don't ever think of it this way, but they might go against historical precedents to drive short-term rates down and believe that they can get that third and final check, because you don't need really much. I mean, we're talking 5.5 to 5.75. I think they would be perfectly comfortable with that. Now, if you don't get that on a 30-year yield, can you get that on the short-term side? So that's another dynamic out here. But it is, to your question, a lot of people say, well, Trump wants lower mortgage rates. Softer labor data could get you there. We wrote that article, a few months ago. If Trump wants lower rates, he has to talk about the labor market getting softer. He can't do that, right? Because the economy
Hmm.
has to be booming or anything like this. And we go back to 2018 and 19. The economy started to perform better once all the trade deals and all that went away. So you can make a case that the first half of 2025 was basically a subversion of what we saw the trade war tap dance back then, where business investment, went down to zero and companies didn't know what was going on. You get more clarity working from a low bar. You can make a case that the labor data picks up and consumption picks up, but it's one of these things that, like, you have your own models for economic cycles, and it's never a good thing when you have the lowest 3-month job creation average, and then you have manufacturing jobs being lost, and then you have residential construction jobs being lost. And when we look at economic cycles, that's not what we call a solid marketplace, and you're basing everything on a low on unemployment rate. But I don't know, where the Fed is really pushing it here, but I understand what some people are saying. Trump got what he wanted, a weak labor report, and he comes out and said, it's fake. I'm going to fire the BLS person and get my own guy in there. So it's just, we'll see. We'll see. I don't know if the gentleman could tell Trump, hey, listen, the jobs data is not good. So I hope he does. If the labor data is weaker, I hope he sticks to the rules. So we'll see. But there is a good case to make that this is a very, very low bar now to beat on the labor side. And how does the bond market and the Fed react?
Okay, so one of the reasons that Trump has backed off of firing Powell, which he would love to do, is because you had such a strong market reaction to it. So now we know he's doing the end run and going, okay, I'll just pick off governors one by one. I'm also wondering like this if the jobs data comes in and people feel like it's been fudged, do you have the same market reaction as when he wanted to fire, Powell? Because it's like, you're messing with stuff. Now we can't trust it. Like, do
No,
you think that there could be a
I don't think
bad
the
market
market
reaction?
reacts to a hypothetical theory because bond traders are here to make money. And we always say, like, why aren't there
Okay.
any bond vigilantes? Like people always talk about bond vigilantes. They're gonna show the government that you can't keep on spending money. Where are they? Where the hell are they? It's been decades and decades. Why? Because bond traders are here to make money. And if you think the 10-year
Okay.
yield is going lower or whatever, and you don't do it, you will get fired. Your wife will get really mad at you, and you can't tell her that, by the way, this is an ideological principle that I think we should be selling the 10-year. Nobody cares, right? So we always like to do these
Right.
hypothetical theories that the mark, well, would it be really shocking if jobs came in at 150,000 and we revised them? To some people, yes. To other people, say, "Hey, listen, we there was a lot of market distortion. We had Godzilla tariffs. Nobody knew what was going on. So now that's somewhat, going away. Maybe companies will feel better." It's just that the jobless claims data has been the golden egg for us, and it's still not showing a labor market breaking. So I don't think I think we always like to emphasize the market. Well, the market has just crushed. I mean, absolutely Hulk smashed the people that said the 10-year yield should go at 6%. The government is broke. Nobody trusts the data. Inflation is. I mean, you're like Hulk, like those two big hands are just destroying that. And the 10-year yield is here, and the 10-year yield and mortgage rates being here look normal to a market function. So
Okay.
we'll see how this goes, but it's really fascinating that we're at this stage of the economic cycle. And again, under no circumstances we want a forever economic expansion. Recessions do happen from time to time, and the jobless claims data has always been my line in the sand since 2022. It is still held up, but it becomes a little bit more interesting going out the rest of the year because of all the other data lines that we have put into the system that show a labor market getting softer, not breaking yet, but softer. But where's Fed policy? It's not a neutral. We're not even talking about a accommodative stance yet. My God, if the labor market was breaking, does the Fed go into a accommodative stance?
Yeah.
Yes, they would normally, but man, it's not normal, but it's a lot of fun if you're an economic nerd because there's a lot of things going on in 2025 that we're just not accustomed to in the last 20, 30 years.
Bill Pulte sent another recommendation to Pam Bondi at the DOJ to look, consider investigating, bring charges against a third property that potentially has problems that Lisa Cook owned. So I hesitate to even ask you about this because it's Friday and this is coming out on Tuesday. But quick thoughts. Anything could happen between now and then.
Um, I mean, this might happen before this podcast even comes out, but
I know.
I do not believe Fed Governor Lisa Cook is going to be part of the Federal Reserve anymore. Because
Yeah.
you know, in 2020 there was a lot of investigation into Federal Reserve members, for investing and trading and stuff that they broke, and there was a lot of backlash on the lack of a governing around the Federal Reserve. So whatever anybody thinks, the game is changed with President Trump and Pulte in house. So if the Federal Reserve does their own investigation and they say, yes, this is true, so what their choice is would actually, would be perfectly fine for Trump and Pulte. So that's what the game plan was. They wanted the Federal Reserve to have this information and make their own decision out there. And I think there is some trepidation about, listen, if this is a legit thing, we have to govern our own people. I don't see how she stays. They
No,
would
I don't
have to.
either.
I mean, unless her lawyers tell her because they said it was a clerical error. I, I, in this environment, you can't have clerical errors out there. Whether you agree with this or not, it's hard for me to see her staying at this point out there. So and I always say that Colger, she resigned early. What was the story on her? So this
Yeah, we
is
don't
New
know.
York bully ball, right? We said this from months ago that they will go after Fed governors now because it's a chess game, right? You take this percent, I take this percent, put my percent, put my percent. I've got more votes versus you. This is a civil war right now between the United States government and the Federal Reserve, and Trump is getting his people in there. This is how it operates. Whether any of us agree or disagree with this, it's really tough in this environment to see her staying unless they can 100% with no equivocation whatsoever say that, hey, this is all, none of this was fraud and anything, because this is never going to leave. And I say this because Lisa Cook is probably one of the more dovish Fed members who is actually talking about the productivity gains in AI and that that's not going to be inflationary. They don't care. They do want their own people in there out there. And man, as we said.
Yeah. So, a couple of things to note. I think Powell's job got even harder or worse this week, which is hard to see because I think she waited a couple days to see is he gonna stick up for her. He didn't, so she named him as one of the defendants in her suit against Trump, the Federal Reserve Board of Governors, and Powell. At the same time, he's getting pressure. We just saw a tweet or a social post from Pulte saying, the fact that Powell is letting her, staying in her office and still has access to her computer and all that stuff. So he is getting squeezed on both sides even more. Like I do not envy Jerome Powell. Whatever you think of him, like he has a very difficult job.
And we brought this up, was November, December of last year. Get ready
Yes, we
for, I
did.
mean, if you guys look at all the headlines that we have written, all the podcasts, this is going to be a war. This is going to be a war that not a lot of people have ever been accustomed to. But this is how President Trump operates. It's bully ball. And there is no relenting out here. And this was set in October of 2024, right? The game plan, the shadow Fed president, the going after governors. There. This is a methodical process that has been in place for some time, and I would have to say, in this sense, Trump is winning because he's starting to get more people on his side. And if they get elected, see, this is why I really think I'm really hoping that it's Christopher Waller to be the head Fed chairman, because he's not going to have emergency rate cuts down to 1%. But what if Kevin Hassett is the
Right.
next Fed? What if Malpass? What if Kevin Warsh? We get into this whole new ball game with U.S. economics that's could be much different. But interesting times, Sarah Wheeler. We said the second half of 2025 is going to be lit, and we still got a few more months left for the rest of this
I,
year. And the chart daddy's
oh my
50
gosh.
now. It's just going to be a lot more fun.
Okay, you're half a
I
century.
know.
Have you considered you're now half
I'm
a
half a
century?
century, and I feel great, man. It's almost not fair.
Yeah,
No country has a
we
no
appreciate
country
you
has a
so much.
Dorian Gray labor market. We all eventually age and die, but man, with modern day food and technology and health and everything, boy, 50 now in 2025 looks a lot different than 1775.
Well, we need you around for another half
Of
century at
course,
least.
I'm going
So
to be for. I always tell the American Bears I'm going to outlast all of you. I've seen some of you guys. You're not lasting another 50 years. Okay, so we will do this, and when I pass away in the afterlife, my brother or sister after me will do it. And this constant battle versus the American Bears and the American Bulls, as all American Bears have failed since 1790 for a reason.
1790. Okay. Logan, thank you so much for being on. Enjoy your birthday and we will talk
Pleasure.
soon.